Net zero by 2050. EU versus USA. Next on the Energy Newsbeat Daily Standup.
Trump's nuclear energy overhaul sparks unfounded alarms of safety. In a bold move to reactivate America's energy sector, President Donald Trump has unveiled ambitious plans to quadruple U.S. nuclear power capacity by 2050. Michael, this is absolutely amazing. The overhaul includes executive orders aimed at reforming Nuclear Regulatory Commission, the NRC, accelerating deployment of advanced nuclear technologies and streamlining the regulatory process. But Michael, wait a minute. We're not sure if we want to go that fast. Christopher Hansen, the recently fired NRC chairman, highlighted this issue, stating that his termination was contrary to existing law and long-standing precedent. I'm wondering if he was a member of the deep state, is my opinion. Organizations like the Bull of the Atomic Scientists also critiqued the approach. Now, Michael, on this story, I just interviewed James Walker, who is the CEO of Nano Nuclear Energy's Breakthrough. Let me explain what he said. He said they've got 2 reactors they've got licensing for, but guess what they're building? 2 plants that once they get their reactors done at the same time, they're building the plants at the same time so they can mass produce quality control modular nuclear reactors. They're going to have controls on these things. And I think that if you had the old way of looking at how regulatory processes is done, I'd be a little worried. But guess what? They're doing it under strict guidelines, and they're going to have mass-produced nuclear reactors. That's different. And I think that's the only way we're going to make all of the numbers that President Trump wants to hit.
Well, and I also think the interesting part about this is the regulatory environment is really holding back the private investment in this. If there was an ability to actually turn a nuclear facility online, use it to do other things, power a data center, actually sell energy to the grid, I think you'd see a lot more nano nuclear style companies coming out and wanting to innovate in this space. I think the fact that they've done this and have been doing it for years, despite the regulatory handcuffs that they have, is actually really impressive. So I encourage everybody to go check out that interview you did with James Walker, CEO over there at Nano Nuclear. But I think you hit the nail on the head. I think these quadrupling nuclear power capacity by 2050, that's what he said. And the correct term you use in the article, it's ambitious. Why is it ambitious? Well, because of the regulatory framework. And luckily, we have somebody as the Secretary of Energy, Chris Wright, who specifically understands that.
Right.
Now, do I think we're going to be able to hit this? I don't know. It's ambitious. Massive reform. I love this. You said, you also wrote here in this article that Trump's strategy is outlined in multiple executive orders that he signed back in May of 2025, which includes the reform of the Nuclear Regular Commission, which calls for a comprehensive review of all the NRC regulations within 18 months and sets aggressive deadlines for permitting and licensing, which is exactly what we need.
Yep, I agree. Hey, let's roll to net zero has cost Europe's energy future. You can't buy this kind of entertainment. Europe's ambitious pursuit of net zero emissions by 2050 was once hailed as, Michael, guess what? A bold step towards a sustainable future until you remove the subsidies. However, contingent grapples with skyrocketing energy prices, industrial decline, and heightened geopolitical problems. It has become clear that these policies have come at a steep cost. Yeah. Germany's deindustrialization is a cautionary tale. So goes Germany, so goes the European Union. Compounding this, the cutoff of cheap Russian natural gas following the 2022 thing. Michael, France over the last several years, maybe the last 8 years, has quit paying their maintenance, and they're still running at a fraction of what they could on their nuclear because they go, oopsies, we don't like nuclear. So they quit paying their maintenance and they can only bring part of their fleet back online. So this is really pretty pretty sad, but it's still. Now, here's where it gets really fun. Europe's import dependency hinging on global powers. With Russian supplies curtailed, Europe is now importing from the U.S., Qatar, and others. And Qatar provides 12 to 14% of Europe's LNG. However, Europe's net zero regulations are being thrown around at Qatar. And you and I talked last week, and they went, not so fast. We don't care about you. You need our gas, but we don't care about you. That's Putin imitating a prince of Qatar, I guess is what that is. The dependency risks is fantastic for the United States. However, U.S. firms are supplying 50% of the EU's LNG, and we've been warned, holy smokes, they're about to come after us if we don't do something about it ahead of time. Net zero equals deindustrialization.
Yeah, it's really true. I think this is a great article. I mean, again, this ambitious pursuit of net zero by 2050. It's almost the tale of two cities here. You've got in the United States, we're going to do nuclear by 2050, which is actually net zero emissions. Ironically, right. And Europe's now coming out and saying, "Oh, well, we're going to do the same thing." But we're going to use offshore wind and solar, two of probably the worst ways to generate energy on the planet. It was really funny watching Trump sit next to Keith Starmer, the UK prime minister. He looked like he just got hit with deer in the headlights. He was talking about how ugly solar farms look.
I've got 6 windmills out this window. I have none out this window. This window's a good window. This window's a bad window. Let's go. It was unbelievable. Let's go fishing. Hey, yeah. Wales fishermen heave a sigh of relief as Burgum cancels offshore wind. I picked this story for you. This is out of David Blackman's Substack, and we highly recommend that you go subscribe there. Interior Secretary Doug Burgum, whose department oversees the Bureau of Ocean Energy Management and the Federal Offshore, dealt the offshore wind industry a major blow this week by rescinding all designated wind areas, the DEAs, on the other outside of the continental shelf. The move is the latest in the string of steps taken by the White House. And Michael, this is huge for our national defense because windmills cause problems with us being able to see ships sneaking in on us. This is absolutely a national disaster, is offshore wind trying to keep an eye on our shores. So I applaud this.
Yeah, I mean, you know, it's if you're like me and are against the whales, this is a sad, sad day. I do believe, I love this image that you've got up in the, is that AI generated? Oh yes, created by Grok. Okay.
Wasn't that fun?
It is funny. Here are the 3 things that basically have sort of read this. I'm just going to read these 3 bullet points, which is commercial fishermen in the Northeast have complained loudly and filed lawsuits over claims that noisy operations and ship traffic has damaged their business. Absolutely true. The advent of construction of hundreds of towers higher than New York skyscrapers coincided with the huge increase in the number of whales and other mammal carcasses washing up on northeastern shores. The collapse of the giant blade from the Vineyard wind turbine caused huge amounts of dangerous shrapnel to wash up on local beaches, creating uproar in Nantucket and other coastal communities, who are the most liberal people on the planet and the definition of a NIMBY, not in my backyard. So here's the 4 policy actions contained. He ended the preferential treatment for offshore and onshore wind projects, restored the multiple use of public lands and waters doctrine observed by every president since it was established more than 120 years ago, providing stakeholders expanded engagement, access mandated under the Administrative Procedures Act, and finally ordering a study to review the winds industry's impact on migratory birds.
And you know what's also important is that the cast of The View has been canceled because they were washed up on the beach. Sorry, I had to throw that one out.
That's unbelievable, but we love it. Let's go ahead and jump over and cover a little bit of some interesting stuff we saw with Chevron and Exxon earnings on the other side here. But first, let's go ahead and pay the bills. As always, guys, thank you for checking us out here on the world's greatest website, www.energynewsbeat.com. Stu and the team, a tremendous job keeping this website website up to speed, everything you need to know to be the tip of the spear when it comes to the energy and the oil and gas business. Go ahead and hit the links in the description below. You can see all of the timestamps as well. You can also subscribe to our Substack, theenergynewsbeat.substack.com, a great place to support the show. Really, you get a nice daily digest directly from Stu and Mai's brain about what's going on and really what these stories in the energy industry mean to you. It's not just, oh, here's the story. It's what's the applicable part? Me as an investor, me as somebody who works in the energy business. What does this mean to me? We break it all down. theenergynewsbeat.substack.com. We'd also like to shout out friends of the show, Reese Energy Consulting. Thank you so much for supporting, guys. If you interact with the midstream space, which if you work in energy, you interact with the midstream space all the time, there is no better firm to help you navigate the complexities of the midstream business than Reese Energy Consulting. Whether you're in an upstream company who needs help with your marketing or first purchaser negotiations, they can do it. Whether you're a midstream company who needs help, working on an ability to maybe permit a new pipeline, or you're putting together a final investment decision on a pipeline, Reese Energy Consulting has the experience, has worked with every size company, from companies where it's two men with an idea in a garage all the way up to the largestly public traded companies in the world. Reese Energy Consulting has you covered. ReeseEnergyConsulting.com. And finally, guys, check out our landing page in the description below if you are interested in investing in oil and gas. EnergyNewsbeat.com/invest if you are interested in investing in the oil and gas space. We basically have you fill out a nice portfolio survey, gives us an idea of where you're coming from. We send you a bunch of free resources. And then we also, if you qualify, point you in the right direction. Investing in energy is a great way to diversify your portfolio, pretty much lower your tax bill to almost nil, depending on where you end up investing. And finally, diversify your portfolio into energy, guys. So energynewsbeat.com/invest, or you can go to investinoil.energynewsbeat.com, whichever you prefer. Hit the link in the description below. I mean, Stu, is a pretty bad week pretty bad Friday for the markets, I should say. S&P dropped about 1.6 percentage points. NASDAQ dropped about 2 percentage points, mainly off the back of interest rates holding steady. To be honest, I mean, here's what I'll say, Stu. I'm in the market to buy a house, so I hated the decision in order to keep interest rates high. But partially, I have to somewhat agree with what Jerome Powell is doing in the fact that on some level, the economic data has not improved substantially to the point where lowering the interest rate is great. I mean, and we can get into it later. My big issue with the interest rate crowd is it's clearly political. It's slightly political from Jerome Powell's side, but it's also political from everybody who wants rates lowered. Nobody wants rates low. Everyone who wants rates lowered just wants rates to go down so that the stock market goes up and Trump can take credit for, quote unquote, increasing the economy, which the stock market is not a proxy for how the economy is doing. So my issue is with everybody making this interest rate debate clearly political. There are good arguments on the side to keep rates where they are. There are good arguments on the side to lower them. And I wish we would just stop making these things so political on both sides and be able to take a reasonable approach. It's my big issue with the way the economy is being managed in the whole term. I could go on a soapbox later, but let's finish up with these numbers here, Stu. The 2-year yield dropped 7%. 10-year yield dropped 3.7%, again, on the back of rates staying where they are. You can see there was a lot of bullishness baked into these numbers here. We can take that for what it's worth. Dollar index down 1.3 percentage points. We did see Bitcoin fall tremendously, but it's actually been up over the weekend here. 114,000 per coin, up about 1.3 percentage points this weekend. Crude oil on the back of that news dropped 2.7 percentage points, or about $2 full, 67.33. Brent oil did about the same, down to 69.33. Natural gas just scraping over $3 at $3.08. And we did see XOP, which is our E&P securities contract, fall about 3.5 percentage points. I think the big thing, Stu, when you look at what's happening from an oil and gas standpoint is, there's a couple things. Obviously, we have the interest rates that has affected, and higher interest rates theoretically means less domestic spending, and less travel. Less discretionary income means people aren't going to travel as much, means less demand for oil. We're also seeing the fact that now Trump is going hard in India. What are you seeing about India per se that is causing you concern? Is there going to be something? Are we really going to go after India's ability to import Russian oil?
I'm really afraid of that, Michael, because it is a gigantic mistake. If Trump does this, this will be one of his biggest errors in his presidency, that he is winning on all fronts. And not only will it be a backlash, it will be a significant backlash. I'm going to disagree with you on Jerome Powell's bit. For if you look at the last,
I'm shocked.
Jerome Powell is a political hack at this moment. And if you take a look at his political motivation, he has absolutely zero reasons for not lowering the interest rates. And I disagree with you on that. So
just question real quick. One question. Who appointed Jerome Powell?
That has nothing to do with it.
Oh, okay. Fair enough. Fair enough.
He is a political hack.
We're going to disagree with that. I think
that he's a political hack.
Yes, because he's a conservative. He's a conservative.
No. When you take a look at the last several times, that there is no the inflation is low, and you are looking at all of the other matrices around it, he should have lowered it. This is the first time since, I believe, 2017 that several other of the Fed chair people filed a complaint and said, we want them lowered. They actually bucked the system, and several of them said that they should be lowering it. That's the first time, Michael, since then.
And if you listen to what I said was there are good arguments on both sides. You can make a really good argument for lowering interest rates, and you can make a good argument with solid economic data that we need to keep rates the same. I mean, the velocity of money being entered into the economy, Stu, has not slowed down. So you really want to talk about paying for our sins in the future? Nothing's changed since what are we going to go back to quantitative easing? Is that what we want? Just QE4, lower interest rates. Let's just pump it. I mean, the problem is if you just the more you lower interest rates, the more you inject money into the economy, which it gets us on this cycle of then inflation goes up. And sure, maybe Trump doesn't care because he's a lame duck president at this point, and in 2028, when inflation comes back, it's going to hit somebody else's. But again, all I'm saying is on both sides. On all sides of this, people are unfortunately taking a political approach when the economy shouldn't be a political approach. And to say that the stock market is a proxy for how the economy is doing is, in my opinion, a fundamental misunderstanding of how the economy works.
I think you quietly hit the key point, and that is Jerome Powell does not want President Trump to get a win on this. And if you take a look at the real estate market in the United States, the real estate market is about to hit a major holdup on this, and there is people waiting to buy houses. You nailed it. You're one of the ones waiting to buy
Absolutely.
a house.
And I would,
and so goes the real estate market. So go the midterms, in my opinion.
And I could go on a long soapbox about this, but in my opinion, the housing market, it's a supply issue that is, with higher interest rates, begins to shake itself out a little bit. Prices have come down a little bit. Yes, it makes it really difficult in the state of Texas, specifically with extremely high property taxes, to find an affordable mortgage. I'm not saying I personally wouldn't benefit from lower interest rates, or there are portions of the economy that wouldn't benefit from lower interest rates. And if you had to put a gun to my head, you never asked me what my opinion was. My opinion is I think you probably should have lowered it a quarter point. My issue is that everybody on both sides makes it political. My issue with people who just are screaming at the top of their lungs they need it lowered is they're just saying it because they want President Trump to win on this. It's not about the policy. It's about the win. It's about the game. It's about, we need, Trump's always right. We need this. It's like, okay, yes, politics should not get in the way of managing the economy. And unfortunately, we've let that happen over the last, really since 2008 and the age of quantitative easing. And if we want to solve the inflation problem, which the inflation problem starts with extremely high levels of debt. I could get on my soapbox for this. We need to get back on energy, guys. The other thing that we saw today, Stu, was OPEC has announced another 548,000 barrel addition to the market. I mean, again, another 108,000 barrels or 138,000 barrels over what they originally were going to do, which is about 411,000. So an unbelievable amount of oil being put back onto the market. Markets are not going to react great to this. We're recording this just before the open on Sunday here at about 3:45. So as you listen to this on Monday, I'm going to wager to bet, Stu, we're sitting at that $65 range. As I mentioned, we're about we closed at about on Friday at about 67.33. I think it's going to be tough. We also did see rig counts drop on Friday down 2 rigs to 540. Canada lost 5 internationally. We gained 1. We did see the frac count sped drop by 1. This unwind by OPEC now is theoretically officially done. They've added back the sweetener on top that they've always done. What do you think, Stu's, OPEC's next move? Are they content now?
I think that they're in trouble because nobody has been able to add back in the actual barrels in their additional quotas. The last 3 additions, they've not been able to actually produce the extra oil. So there is now questions because Saudi Aramco, Qatar, and about 2 or 3 others have all not been drilling as heavily. So there really is raising the question, so what? They did raise the quota. They're not going to be able to do it. So anybody that is really watching supply and demand is going to realize that we are going to be short supply after the partial glut that's there is used up. And I'm still a bull, and they're not going to be able to do it.
No, I mean, yeah. So I'm going to disagree on the bullish. Actually, hold on. Goldman Sachs is actually calling. Wait a second. Hello? Oh, wait, Stu is now your lead oil research economist? Well, great. Oil to the moon then. Thank you. We'll send in the bill later. Turns out, so you're now Goldman Sachs, boom, hired you. It's exactly what they want to hear. But I'm going to take the other side of this. I think oil is going to stay in this 60 to 70 zone. If you had to guess what we're trading at the end of the year, it's probably going to be 65. I think the answer, this cyclical nature of oil and gas doesn't unwind itself so quickly. It causes, I think at the end of the year, we're going to start seeing weakness. I think by the end of the year, we'll start seeing all this quote unquote peak Permian that people are talking about. But I do agree with you. I think OPEC is a little bit in trouble. And it's why I've always stated, I don't believe what OPEC is after is market share. If you just blindly read Reuters, they'll just, they'll throw these headlines, market share at you again. I don't think OPEC is out for market share. I think they're in this extreme catch-22 where they need to diversify their economies away from energy because they feel like they're so concentrated. But the way to do that is actually increase the amount of oil they're doing so they can then take theoretically those excess profits and diversify them away. So I think it's this real catch-22. It'll be interesting to see how all this plays out. We've got 2 earnings, Stu, Chevron and Exxon. I love diving into them because I think what they can show is, I think what they're showing in their earnings, both of them, is the strength of their core business, which is their upstream business. So to give you guys an idea, we'll start with Chevron. They go ahead and announce record-breaking oil and gas production for the second quarter of 2025, mainly, again, due to the fact of their strength, really scooping up things in the Permian, but also their continued investment into the business. They report of earnings of about $2.5 billion for the quarter, which shakes out to about $1.45 per share. It was a little bit of a decline relative to what it was last year. Now, oil prices were a lot higher. They did have adjusted earnings, came in at about $3.1 billion. And it, again, as I mentioned, there is a year-over-year drop, but there is some softer crude prices and affiliate income. The upstream segment actually made more money relative to what they did a year over year because of those higher volumes. In the Permian, they reached 1 million BOE per day, which is about 123,000 BOE increase from Q2 of 2024, mainly driven by their efficiencies in the Permian and the Gulf of Mexico. They also saw a pretty big dip in what we would call liquid realizations, which is your actual realized pricing on your natural gas and your liquids. It was about a 39% drop in profits relative to their natural gas of $2.7 billion. Cash flow from operations was about $8.6 billion, which was up from $6.3 billion ago. Free cash flow about $4.9 billion. CapEx were about $3.7 billion, which is a little bit lower than the year before. I wouldn't necessarily say that was disciplined spending. I think a lot of that that is coming back. They're going to return $5.5 billion to shareholders in Q2. Partly 2.9 of that's going to be a dividend and 2.6 is through share repurchases. Stu, I think the other thing that was interesting to look at is the overall market. As we mentioned, XOP on Friday was down 3.4 percentage points. Chevron was actually only down about 1/10 of a percentage point. So obviously your stock price in oil and gas is going to be pretty tied to pricing, but relative to the XOP, Chevron extremely outperformed. I think people are saying that this is a pretty solid thing. To kind of give you a comparable note, Chevron, Exxon, and ConocoPhillips. If you're looking for, if you're yield hungry and you're looking to buy up all your yield on dividends, Chevron actually has about a 4% dividend yield. Exxon coming in about 3.5 and Conoco at about 2.5 with a variable and fixed dividend. So pretty interesting. They, they're doing a lot better than I think some of their other partners. Anything interesting you saw in Chevron earnings, Stu?
No, but I do think that you're going to see some more Venezuelan oil coming into the Gulf refineries from Venezuela and Chevron. So look for better Q3 and Q4 numbers out of Chevron.
Yeah, let's jump over to Exxon earnings, which was a little bit under what analysts were expecting, or well, I should say it was less than what first quarter's earnings were, but was actually a little bit higher than analysts' expectations. Earnings came in at about $7.1 billion, which was about $1.64 per share if you include dilution. We did see this. The street was thinking that the earnings were going to come in somewhere in that 1.5 to 1.56 range. So it's about a 5.13 surprise over what forecasts are. I mean, it's pretty incredible, Stu. Revenue for the quarter came in at $81.5 billion, which beat projections. A lot of what this is doing is coming from their rolling of Pioneer. I'm trying to think about what their overall, I think they're projecting over Permian was about 1.5 BOE per day for the full year 2025. That's their average, a 50%. And then by 2030, they're going to hopefully be at 2.3 million barrels. So they're forecasting a 50% increase. And I think that's a lot of what people are doing that. It is interesting to note that even despite these big results, Exxon actually's quarterly profit was the lowest it was in 4 years. Again, that has a lot to do with oil price, but also has to do with some refining margins in their downstream segment. Year over year, their earnings dropped about 23%. I think they're forecasting about a 15% decline in oil production from just natural decline. Obviously, trying to add in more production, specifically coming from Guyana, is going to hold that. The street did like their earnings report relative. They were down about 1.7 percentage points, so still about 2 percentage points, but clearly they performed a lot worse than Chevron. So if you're wondering who did the bet, who's in better shape coming out of Q2 2025, it's definitely Chevron. And I think Chevron is also getting a little bit of a beat relative to them being able to acquire Hess, which is going to get them into Guyana, which is the best asset right now on the market. So pretty interesting, Stu. What else did we miss, Stu? Oh, we have a big announcement. Drum roll, please. We're moving to 3 days a week. We want to keep providing the same level of insight. We want to make the shows a little bit longer, dive into stories a little bit more, and we're moving to 2 to 3 shows per week. Some weeks we may have 2 shows, some weeks we may have 3 shows. So you're still going to get the same great content, but it's going to be coming in a little bit of a different format. So this will be our last week doing a daily show. We'll move into a weekly style 2 to 3 times per week. We're still trying to nail down what days those are, but trust me, guys, you're going to still be hearing a bunch from us. So we wanted to throw that out there real quick. But Stu, what are you worried about this week?
Oh, just trying to watch the world and sit back and enjoy the show. Get the popcorn. Yep. Central casting.
Central casting, guys. So with that, we're going to let you get out of here, get back to work, start your week. Appreciate you guys checking in with Energy Newsbeat to start your week. For Stuart, Turley, I'm Michael Tanner. We'll see you tomorrow, folks.